Every year, the government takes a percentage of the money you earn before you ever see it. Not after you spend it. Not after you save it. Before. And most people, if you asked them to explain exactly how that works, would stare at you like you just asked them to describe the color of wind. They know it happens. They feel it every paycheck. They just have no idea how the machine actually runs. That is not an accident. Here is what almost no one tells you. The income tax system was not designed to be understood by the people paying into it. It was designed to be complied with. Those are two very different things. Compliance means you follow the rules. Understanding means you know why the rules exist, who benefits from them, and what the rules quietly do to your financial life over the course of 40 years. Today, we are going to do the second thing. Let's start at the very beginning, not with forms or brackets, but with a question. Why does a government need your money at all? Think about it like this. A government wants to build roads, fund hospitals, pay soldiers, and keep the lights on in 10,000 courthouses. It has no product to sell. It cannot run a factory. The only thing it controls is the legal authority to take a portion of the economic activity happening inside its borders. Taxes are not a donation. They are not optional. They are the price of operating inside the system. Once you understand that, everything else makes more sense, including the parts that are designed to be confusing. Now, the United States uses what is called a progressive tax system. The word progressive here does not mean good or forward thinking. It means that as your income rises, the rate at which you are taxed also rises. This sounds obvious until you realize how many people fundamentally misunderstand it. There is an enduring myth in this country that if you get a raise and cross into a higher tax bracket, you will somehow take home less money than before. People have turned down promotions over this. They have restructured their freelance income over this. And it is completely, demonstrably false. Here is why. The tax brackets do not work like a light switch. They work like a staircase. Imagine you are filling a bathtub that has 5 different sections, each one slightly higher than the last. Water fills the lowest section first, then the next, then the next. Your income works the same way. In 2024, the first roughly $14,000 you earn is taxed at 10%. The next chunk, up to about $55,000, is taxed at 12%. Then 22%. Then 24%. And so on up the ladder. When people say they are in the 37% bracket, they do not mean that 37% of all their income goes to taxes. They mean that their last dollar of income was taxed at 37%. Every dollar below that threshold was taxed at a lower rate, just like everyone else's. A person earning $500,000 and a person earning $50,000 pay exactly the same tax on their first $14,000. The wealthy person just keeps climbing stairs that most people never reach. This is where it starts to get interesting. Or uncomfortable, depending on your perspective. Because the staircase we just described only applies to one type of income. It applies to wages. The salary you earn by showing up and doing work. But there is another type of income in this country, and it lives in an entirely different room of the tax code. It is called capital gains. This is the money you make not from working, but from owning things that increase in value. Stocks. Real estate. Businesses. If you hold an asset for more than a year and then sell it at a profit, that profit is taxed at a rate that tops out at 20% for most high earners. Not 37. 20. For someone in the highest wage bracket, the tax on their last dollar of salary is nearly double the tax on their last dollar of investment income. This is not a glitch. It is a policy choice, and it has been a policy choice for decades, regardless of which party controlled Washington. Now pause and really sit with the math here for a second. A surgeon who earns $400,000 a year doing 16-hour shifts and carrying enormous liability pays taxes on most of that income at the highest marginal rates. A person who inherited a portfolio of stocks worth $5 million, does nothing with it for a year, and sells it for a $600,000 gain pays taxes on that gain at less than half the rate. The same government. The same country. Two entirely different tax treatments based not on how much you made, but on how you made it. Whether you find that fair or not is a separate conversation. But you should at least know that it exists. There is another layer under this that most people never reach, and it is the one that determines whether the math actually adds up in your favor over time. It is called the effective tax rate, and it is different from the marginal rate. Your marginal rate is the percentage you pay on your highest dollar of income. Your effective rate is the percentage you actually pay across all your income after every deduction, credit, and exemption has been applied. These two numbers can look wildly different. Someone with a marginal rate of 24% might have an effective rate of 16% because of mortgage interest deductions, retirement contributions, child tax credits, and a dozen other mechanisms baked into the code. This is not cheating. This is the code working exactly as designed. The problem is that navigating those mechanisms requires knowledge, time, and often the ability to pay someone who already has both. A household earning $60,000 a year in wages, with no accountant, no investment advisor, and no inherited knowledge of the tax system, tends to pay closer to their marginal rate than their theoretically possible effective rate. A household earning $600,000, with a tax attorney and a wealth manager on retainer, tends to drift their effective rate significantly below their marginal rate. The code is technically available to everyone. The literacy required to use it is not evenly distributed. This brings us to the piece of the picture that expands when you zoom out far enough. The federal income tax is only part of what comes out of your paycheck. Before you even get to income tax, there are payroll taxes. FICA, Social Security, Medicare. These take 7.65% of your gross wages, with your employer paying a matching 7.65% on top of that. But here's the part that changes the math dramatically. Social Security payroll taxes only apply to the first $168,000 of earned income as of 2024. After that threshold, they stop. A person earning $200,000 pays payroll taxes on $168,000 of it. A person earning $40,000 pays payroll taxes on every single dollar they make. The effective payroll tax rate for lower earners is therefore higher, as a percentage of their total income, than it is for higher earners. This is not a secret. It is in the statute. It is just not something that comes up at the dinner table. Add in state income taxes, which vary enormously, sales taxes that hit lower income households harder as a percentage of spending because they consume a greater share of their income, and property taxes that fund local schools in ways that entrench neighborhood wealth gaps, and you start to see that the tax system is not a single system. It is a stack of systems layered on top of each other, each one with its own logic, its own winners, its own beneficiaries, and its own political history. None of this was assembled overnight. The modern income tax in the United States was ratified into the Constitution in 1913, which feels like ancient history until you realize that every bracket change, every new deduction, every credit introduced since then was lobbied for, negotiated over, and agreed upon by people who had specific interests in what the outcome looked like. The mortgage interest deduction was created when homeownership was a national priority. The carried interest provision, which lets certain investment fund managers pay capital gains rates on what is functionally their salary, has survived every attempt to eliminate it for reasons that have more to do with political fundraising than economic efficiency. The tax code is not a neutral document. It is the accumulated record of every political compromise made since Woodrow Wilson was president. So here is where this leaves you. Every year, somewhere between now and April 15th, you sit down with a number on a form, and you write a check or you receive a refund, and the transaction feels singular. One number. 1 year. Done. But what you are actually participating in is a mechanism that has been running continuously for over 100 years, shaped by interests you were not part of, containing thousands of decisions made by people you never voted for, expressing values that are encoded in obscure subsections of a document that is, at this point, several thousand pages long. And the outcomes it produces are not random. They are structured. The structure favors certain kinds of income over others, certain kinds of wealth over others, certain levels of financial sophistication over others. Understanding how taxes work is not going to make you rich. It is not even going to make you feel better about paying them. But it might make you better at asking a question that very few people actually ask, which is this: who decided that this is how it should work, and what would have to change for it to work differently? That question has an answer. It just might not be the one you were hoping for.